Okay. All right, recording. All right, we are going to share this. So talking about the bank statement, when the customer pays the company, we've been tracking all this money owed in accounts receivable, but when the customer pays the company, cash goes up. That's a debit to cash. When the company pays its suppliers, we've been tracking all that in accounts payable. Or if it's our employee, we've been tracking that in salary and wages payable. But when the company pays its supplier, that's cash down or credit. Here's our cash T account. Cash increases with customer payments. Cash decreases with payments to our suppliers or employees. All right. So payments out. Let's say the company pays a bill to a supplier for $29.50. So company prepares a check. The check is signed. Once the company does that, because we have computerized systems, the system immediately credits the cash account, showing that the cash is lower. And then it debits accounts payable, showing, well, we don't owe that money anymore. So debit accounts payable, credit cash. Okay. When we receive money from a customer, so let's say that the customer pays us $20. Here's that cash account. We increase cash, we debit cash $20, and we credit accounts receivable. So all that's going on all month long, over and over and over again. Okay. All right. So all month long that's happening. The company's paying suppliers or employees, and cash is going down. All month long, customers are sending checks to the company to pay their bills. So we get the money, we deposit it in the bank, but first we record it. And then we physically go to the bank and deposit it. And when we get that statement from the bank statement, we say, did all our deposits get recorded correctly in the bank? Okay. So here's the bank statement, and it's going to show the beginning balance, all the checks paid by the bank. So what does that mean? That means we mailed a check to our supplier and the supplier deposited it in the bank and it got deducted from our account and increased into the supplier's account. It also should show all the checks received and deposited by the bank. So when we went to the bank every couple of days with a deposit, we make the deposit and it gets put into the bank account, and then any miscellaneous deductions by the bank and any additions by the bank and the ending balance. Okay, so this is a sample bank statement. The bank is Anchor. The company name is Wilson. This column here shows all the increases to the bank account, including this one, a miscellaneous one. These columns here show all the individual checks that the company wrote and the individual check amount and some irregular ones down here, charges. Okay, let's go back to the deposits. The deposits are not listed by check, they're listed by day. So $420, $630, that could be 5, 10, 20 checks. Okay, all right. And then the daily balance, we don't really use that as much anymore because we can look that up so easily, so we don't need it on the statement. But here you see the ending balance. So beginning balance, beginning November 1st, ending balance November 30th, total adds, deposits, total subtractions, checks. Now, banks use opposite terms for credits and debits, so you just need to know that, because they're looking at it from their point of view. Okay. So to do the bank recon, the company scrutinizes this statement, checking off and making sure that all the checks they wrote cleared the bank as of November 30th. Of course, if they wrote a check December 1st, it's not going to have cleared the bank, but all the checks they wrote by November 30th. And you can see there's a gap in here. The 167 and 168 are missing, so they haven't cleared the bank yet. Maybe that supplier, that vendor hasn't deposited it yet. And then you always look at the last check and you say, that's the one that cleared the bank, but did we write any more checks by November 30th that we need to account for? And the answer is yes, we did. So we'll take those into account. So to start out the bank recon, we go look at our T account, and I'm going to give you this number, 532269. You just have to get that number. And then we already have the bank statement balance. So the bank statement rarely equals what you have in the cash account, and it certainly doesn't this time, and it's all because of timing issues. All right. All right. So we have a couple of issues here. I'm going to jump ahead and show you what the bank statement looks like. So you make two calculations, and you don't have to be real formal. This isn't like an income statement. You just have to write the right things down in each column. Okay, so I'm going to jump ahead. So left column or right column, I don't really care which, but I usually put the bank on the left side and the books on the right side. You can see we start with the ending balance per the bank on the left side, and we add up to an adjusted balance. In a separate calculation, we start with the balance in the T account as of 11/30 in my example. We make some adjustments, and we ended up with an adjusted balance. And we call this reconciled if these numbers are in agreement. In other words, we've taken into account all the timing issues, and there's no errors left. Okay, all right. So what are these things? On the bank side, you're going to add any deposits in transit, and you're going to subtract any outstanding checks. So if you see deposits in transit, it means that the company got the money, they collected the money from the customer, but they haven't made it to the timing is such that they recorded it, but the bank hasn't recorded it yet. For example, let's say they go to the bank and the bank is closed, and they say, oh, I'll deposit it December 1st. So they come back to the company, they put it in the safe, they lock it up, and then December 1st, they deposit it. But they received it on November 30th. They received those checks on November 30th. So they recorded them correctly as receiving them on the 30th. The bank doesn't get them till the 1st. So it's a timing issue. So $225 was a deposit in transit. Now, how do you know that? You literally have to go back to this and tick off all the transactions here and compare them to your transactions in your T account. You guys don't have to do it. We give you that as the problem, but that's how it works. So they'd say, oh, we did this. Oh, we did another one here for 225 on our T account, but it didn't get into the bank until the December 1st. So we'll add it here. Outstanding checks. As I said, we were missing 2 checks in the middle of the sequence, and we checked to see if these last 2 checks or any checks were written on the 30th, and there were 2. So we start here, we add the deposits in transit because that would increase our bank account, and we subtract our outstanding checks because that eventually will reduce our bank account, and that's our adjusted bank balance. This side is you start with your T account balance for cash, and these 4 items you just pick up off of the bank statement. So you go to the deposits and you say, what's that? CM. What's these 3 things? RT, DM, SC. Okay, we know it's increasing, so we're going to add it here. We know these 3 are like checks, they're withdrawals, they're decreasing. So we're going to subtract them here. And now your job is to read the problem and discover what are the descriptions of those 4 things. You need the description because you're going to have to make a correcting journal entry. Okay. All right, so let's look at them. Let's see, where did I have it? Timing issue. No, let's go forward. Sorry, guys, I'm flip-flopping here a little bit. Okay, so I already talked about these. Deposits in transit is added to the bank. Outstanding checks are deducted from the bank balance. Now we've got this CM. So the problem has to give you a little more information. You know you have to add it, but you have no idea what it's for. So the problem has to tell you. And so it says the bank collected a note and deposited it to the company's bank account, but it was not yet recorded by the company. So you're going to add the 300 to your book balance. Then it also says the bank charged a $5 collection fee. So we know if the bank charges a fee, we know it got deducted. So we're going to deduct that from the book balance. And we're going to call it collection of note. And here we're going to call this collection fee. Okay, so now we have two more items, $35, $40, and $10. So let's start with the $10. The bank charges a $10 monthly service charge. Okay. So we knew that was subtracted because it's in that column that says checks or debits. So we're going to deduct the $10 from the book balance and we're going to call it service charge. Okay. The RT is an interesting situation. It's a bounce check. So what that means is a customer paid the company. The company recorded, we got $35.40 debit cash, credit accounts receivable because it's a customer. The company deposited it. And a few days later, the other bank, the customer's bank, said they don't have enough money for this. And they pushed the check back to the original bank. And so the bank says, whoops, we got to reverse this and charge it back to the company. So this is called an NSF, not sufficient funds. Okay. And we subtract it from the, we deduct it from the book balance. Okay, so back here again, we've already done this side. We knew we had to add the 300. We knew we had to subtract these three items, and we just had to read the problem to get the description. Bank collected a note. Bank charged a collection fee. NSF check, return transaction is how the RT, and then there was a service charge. Okay, so that's the bank recon, all done. Okay, all right, so anything here, anything on the book side, we need to do a journal entry. Okay, so I want you to think about that T account. Collection of a note. We're adding it here, so we're going to add it. We're going to create a journal entry. We're going to add it to the cash account. So debit or credit to increase cash. So for the 300 only, debit or credit. I'm going to put $300. So give me a D or a C here. I have to make 4 journal entries for each of these 4 items. That's my last step in the bank recon. Debit or credit. Let's see. So we're going to increase cash. So if we increase cash, is that a debit or credit? Srishti, correct. Fair, correct. So these adjusting journal entries, I want you to visualize them. So here for collection fee, we're going to make 3 separate journal entries, actually 4, but for these 3, we're reducing cash. So debit or credit to reduce cash. Fair, you are correct. Tara, you are correct. So strategy for an exam, you may just panic on the bank recon or whatever on the journal entries, but you can do half a journal entry. You can do the cash piece of it. You can say entry 1, cash went up $300. Entry 2, cash went down $5. NSF down $35.40 and service charge. So let's look at what we do here. So you must create journal entries for all the items just on the book side. And you can do number 1 is 2 journal entries or 1. I don't care. To reclassify the NSF check back to accounts receivable because it was not collected, and to book the $10 bank service charge. Okay. So the first journal entry, debit cash, 300. And because they told you it was a note receivable, if they hadn't told you, if they just said the bank collected $300, then you would default to accounts receivable. But if they tell you it's a note, use a note. And then the $5 for collection expense, let's just call it service charge expense. Okay. And you'll see cash was debited here, and over here cash was credited. And I'm combining them into one entry. You could combine the cash and just make it $295 if you prefer, whatever's easier for you, like this. Okay. And then the NSF check, here we go. Reducing cash here, because we didn't collect the money now. And then, let's see, we got that coming off the page. Reducing cash and then debiting accounts receivable. We're just reversing that recording of collecting the money. And then finally, the service charge expense. Let's see if we can do that. Service charge expense debit, and again, cash goes down. So you had 4 journal entries or 3, depending on how you set them up. Debit to cash, credit to notes receivable, debit to service charge expense, credit to cash, or combine those 2 into one entry. Credit to cash, debit AR, credit to cash, debit service charge expense. And of course, we always put the debits first if we can. Okay, so imagine this was your beginning balance here, 532269, added 300 for this transaction after we posted those journal entries, subtracted the 3 other transactions, and now we have a T account that is correct and reflects all the transactions in the bank statement. And that would work only if you did the bank reconciliation on December 1st before booking any other journal entries. Okay, so just to be clear there. Okay, so you're going to get more complicated. You're going to get more complicated bank recons, but just use that basic format. You know, you don't have to make it real fancy. Just put balance per bank on the, let's see, which way is it? Balance per bank on the left side, balance per book on the right side, beginning balance, and then each item under bank, deposits in transit, outstanding checks, and any errors. There's always some of your problems will have errors with the bank. On the book side, beginning balance, and then anything on that bank statement that hasn't been recorded by the books. Okay, and you should, this is one actual activity where you will know it's right because it has to reconcile, and it has to be, you'll know immediately if it doesn't reconcile because you will not be in balance at the bottom. They have to be equal. Okay, well, I will see you guys next week. That'll be our last time we meet, and then you guys will do the final on Wednesday, so a week from tomorrow. All right, I will see you later. Unless you have any last questions, we have a couple more minutes, but thank you. You're welcome.
Thank you.
See you later. Hope you guys are doing okay. Not too stressed. You're welcome, Kaylin. See ya.